Hello and welcome to Gold and Silver Assets. It's Sunday, the 12th of July 2020. So 3 weeks ago we talked about bubble tops and pops. And so this week I thought we could talk about the opposite situation of the bottoms that occur in the bear markets after the bubble has popped. And for those who don't like technical analysis, just a warning that this presentation may contain nuts. So let's start by discussing the psychology that occurs at the bottom of a bear market. So just the same as bubble tops, it's very difficult to know that you are at the bottom when you're in it. And it's one of those things that's only really obvious in retrospect. When good news occurs, it's often ignored and doesn't really have much of an effect on the price of the asset. I find it's also useful to look at what the mainstream media are saying about the particular asset. So my impression is that as the bubble pops, so the early stages of the bear market, they tend to report the drops. Then they tend to go quiet and don't even mention it. And then in the final stages, they are often strongly negative, and often you can hear the phrase that the asset class is dead. And the other thing that happens at the bottom is that the retail crowd are completely uninterested. They absolutely hate that particular asset. And anyone who tries to call the bottom and express any hope of prices rising get mercilessly berated using strong emotional negative language. So one example of this from this channel was someone who commented that he would rather put his hand in a blender than invest in silver. And to me, that sounds like bottom kind of language. Meanwhile, as the retailers are complaining, the smart money is quietly buying and accumulating. Now, this all sounds very straightforward, and I'm sure we're all capable of spotting these kinds of signs, but the problem is that there is subjectivity involved in this, and it's not as if these signs all happen at a single time point. It's kind of over a period of time. And so it won't tell you exactly when things are going to turn around. This chart nicely shows some of the emotions that occur as prices drop during a bear market. And this is something that all of us, including myself, have experienced at some point. So as prices drop by a small amount, so a 5% drop would be considered a normal pullback, and even a drop of 10% is seen as just a healthy pullback or correction. And as things drop further, there's that buy the dip kind of thoughts where people say, oh, stocks are on sale, this is a good time to buy. Then prices might move sideways for a while, and then when they get to 20%, you start to say, well, let's see, it might turn around here. Once you get past that 20% level, and 20% is an interesting psychological level in the markets, and once things get below that, that's when people really do start to worry. So with a 25% drop, it's starting to feel serious. And then a 30% drop, then you tend to turn into a longer term investor. So people say, oh, I won't touch this for 15 years, so it's bound to go up and I'm bound to recoup my gains. But things continue to drop. Here they had a steep drop, and then at around 40%, this person said, I'm out. And then as things drop further, then there's that sense of relief. I'm so glad that I sold. And then once things get even lower, then they start to think, oh, maybe it's worth getting in. But then as things drop even further, that's when people really, really give up and they say, I've had enough. I'm not investing in this at all. I'm never coming back to this market. So can we use chart patterns to determine where the bottom of a bear market is? Now, the problem here is that there are lots of possible reversal patterns with the potential of pattern failure, which can occur as the bull market's progressing. The common ones that you hear about are the double or triple bottoms or the inverse head and shoulders. But you can also get other patterns like the rounded bottom or different types of triangles. And so using patterns to determine a reversal can be very difficult. It can sometimes look like the pattern's broken out and it can just fail and go the other way. This chart shows us the 4 phases of an asset bubble. And in this video, we're going to mainly concentrate on this blow-off phase as well as the stealth phase over here. And I'd like to start by drawing your attention to this grey dotted line over here, which is the mean. And we can see that during the stealth phase, prices stay around close to that mean. And that's just before prices take off. Now, after the capitulation event during that blow-off phase, what we see here is that you get an overshoot below the mean before prices revert back to the mean and start moving up. And so this is where the bottom occurs. So that was the theory. So let's have a look at some real life examples. So this is the Nasdaq chart on the monthly scale showing the dot-com bubble. And isn't it interesting how this chart looks pretty much identical to the theoretical chart? So for this dark line here, I basically drew this by joining the lows before what I assumed was the takeoff in price. And this seems to be a good support and resistance level here. And alternatively, you could try and draw the mean. I'm still trying to work out the best way of doing that. But here, I guess, I mean, it would be pretty parallel to that line if we were to draw it in. So what's happened here is that after the bubble popped over here, we had a little bear market rally. This is the capitulation. And here we have what I think is the despair overshoot. And prices then subsequently continue to rise. If we look a bit more closely by looking on the weekly scale, we can see that the line that I drew was initially support, but that subsequently broke, and this is that despair overshoot that I was talking about. And we can see that this mean line became resistance, and so that was tested 3 times, and then on the 4th time it finally broke to continue its upward move. So if we say that this is the bottom here, we can see that there's not really any obvious patterns which we could have looked at prospectively to say, yes, this is going to move up from here. Possibly you could say it was a double bottom, but this is a little bit high. Looks a bit lopsided. Another possibility is an inverse head and shoulders, but again, it does look a little bit lopsided. The only way I can think of calling this would be to wait for this higher low followed by a higher high. And so it would have been at this point. But actually picking this exact bottom here, I think would be very, very difficult. Let's move on to Bitcoin, which is shown here on the daily scale. Now, Bitcoin has experienced multiple bubbles in its 10-year history. So here is one of the bubbles that occurred in 2013. And again, I've drawn this trend line just before prices took off. Now here it's actually got 2 bottoms here. There's not really any obvious pattern to these bottoms. Here possibly we've got a double bottom here. That's pretty steep though, but yeah, that could be seen as a double bottom. But then prices again dip down here, and here we've actually got what looks like a little V-shaped recovery. And again, there's not really any way of saying that prices were going to turn around at that point. However, remember that this is in that despair overshoot area that we talked about earlier. Could we have drawn this trend line prospectively is the other question, because if you look at this price action here, it's actually got a curve, and so drawing a trend line there can be very subjective. I mean, I could have drawn a much steeper one joining these lows. And so that's the thing on this chart that makes it very difficult. And even if you say that you're going to draw a mean price before the takeoff point, well, it's very difficult to say exactly where that takeoff point is here. So this is one of those ones where it's much easier in retrospect, but I don't think that would have been able to be drawn accurately prospectively. Moving forwards in time, the price action from the last bubble in the previous chart is shown over here. And again, I've joined the two lows before prices took off. It's a bit easier to discern over here. Prices seem to have taken off from that point. And we can see that indeed there was this despair overshoot. So it was brief, but it did occur over here. And that was indeed the bottom. But even if you had picked that exact bottom, remember that you'd have had to wait over 9 months before you got confirmation that that was indeed the bottom and the bear market ended. So you would have had to sit through this whole channel formation here before moving on and onwards and upwards. This is the Shanghai Composite Index, which went into a bubble in 2006 and 2007, and this is shown on the weekly scale. And I've drawn this line by joining those previous lows before prices took off in around 2006. And I thought this was quite interesting because I thought it was similar to that 2013 Bitcoin bubble chart where the despair overshoot didn't occur initially. It actually recovered, just went close to it, but didn't overshoot it, recovered. And it was only later that that despair overshoot occurred. If we look at these two, I guess you could say that this was the bottom. It certainly was a much lower price than when the despair overshoot happened. In terms of bottoming patterns, this looks like it was an inverse head and shoulders. But again, it's not an easy one because that neckline is very steep. So possibly this could have been a symmetric triangle. And if we look over here, this kind of pricing showed a descending triangle, which ended up being very bullish and prices just springboarded much higher. And that brings us to silver, which is in two bubbles in the last 45 years. And this chart really illustrates how difficult it is to call a bottom. So this is silver on a monthly scale, and we can see that in the 1970s, just like in the other charts, I've drawn this mean line to just basically joining the lows before prices took off. And we can see that that despair overshoot did indeed happen, but after it recovered, again, it went back into that despair zone. And rather than actually recovering and turning a corner, we can see that silver was crushed to lower and lower levels. And prices actually moved sideways for over 15 years here. When it finally did recover, though, it recovered in a spectacular fashion. As I've said, drawing in these trend lines can be rather subjective, but I've given it a go for silver from before the last bubble. And so price seemed to kind of start to take off around here. So I've joined the lows before that. And if this is correct, then it does look like we are in that despair overshoot for silver here. Now, of course, the big question is how long will we remain here? The take-home message from all of this is that bottoms are highly variable and they're difficult to pick. And it's more of a process than a single point in time. And they can often take a lot longer to play out than the parabolic pointed tops that we see in the bubbles. So I wonder if looking for those despair overshoots might be helpful in terms of avoiding buying before the drop has fully played out. But it certainly doesn't help in terms of timing when the upswing will start. And as we've seen, that can take some time. And so the key here is patience. And finally, it's important to distinguish between a stock that is bottoming from one that is going bust. When prices plummet, there's no guarantee of recovery. So, for example, at the height of the tulip mania in 1636, the best tulips cost more than houses at the time. After prices collapsed, they've never come even close to that price level. And so this is where it's really important to understand the fundamentals of that particular asset and look at the potential catalysts that might lift prices. Next up, the market update. So let's start with gold priced in US dollars on the weekly scale. And we had quite an exciting week this week with more upwards movement. Now, on this chart, we can see that we had drawn this upper trend line by joining the highs over here and here. So we drew this line a couple of months ago, and it's amazing how well that has held, because obviously this week price shot up and actually bounced off of that trend line and came back down again. So that tells us that that trend line is useful here. So the other thing to note is that we've got 5 green candles in a row. Now, you're not going to keep getting green candles indefinitely. You usually do get a red candle at some point. If we look back, we've had times, for instance, here where we had 6 green candles in a row. And over here, 5 green candles. And so we're getting to the point where a red candle is probably due. But remember, it doesn't have to be a big candle. So, for example, after this up move, we just had a small red candle there. There's just a small one here. But basically what I'm saying is that we have had a good run here and we're due a little bit of a break. That doesn't mean to say that has to be anything devastating. Remember that we've still got this whole area here, which is still open to possibility. But the way the markets are going, you know, things do look pretty strong at the moment. So I'm not expecting any devastating crashes, and I think there's a very, very low probability we're going to go below around that 1560 level. Possibly we could just noodle around here for a little while, or if we do get a drop over the next few weeks, I would expect the first support area to be over here in the mid 1700s. And then the next one would be in the mid 1600s, which would bring us to the middle of this channel. The other thing to note is that if we look at the RSI, we can see that we do have some bearish divergence here. So we can see that price is moving up on the chart, but the RSI is moving downwards. So again, that's just another thing to bear in mind. I don't find the RSI overly reliable though, because you can get negation of this. So this would be negated if we got a big shoot up in price through here. Then what would happen is this RSI would come up and that would just get rid of the bearish divergence that was there. So just take that with a pinch of salt here. The question is, of course, is what would propel gold to come through up through this upper resistance area. Remember that there is long-term resistance from back in roughly 2012, 2013 around this area here, and that's the other thing that's making me think we're going to have a little bit of a pause coming up. So let's just take another step back and look at gold in US dollars on the monthly scale. And what I want to do here is look at the RSI, and we can see that at the moment we're just around 80 over here. And I wanted to look back and see all the times where we had hit that level. And this chart goes all the way back to the mid-1970s. So the first point where we hit 80 was over here. So let's zoom in on that area of the chart and see what was going on. So this is that spot where we hit 80, and that was a green candle over here. And that was followed by actually quite a substantial red candle there. And that knocked the RSI back. And that was subsequently followed by a further up moves there. Okay, so the next time it hit 80 was just over here. So let's have a look at that. So again, I've drawn in this blue line where the 80 level is. And so it first hit it here. And again, that was a nice green candle here. But you can see that it's actually followed by more up moves. And so the RSI got even higher over here. We had just had a little bit of a red candle, but that only barely brought it back down to below the 80 level, and then price shot up. And this whole move, you can see the curvature there, that's a parabolic move, and that was that bubble that we saw over here. So of course that brought the RSI even higher. But when you get such strong moves, that's often followed by that crash. So that was a bubble top here that we saw. Okay, so when was the next time we hit 80? That was over here. So we had a long period of time where it didn't even get close to 80. Let's have a look at that area here. So that's over here, and I've zoomed in on it over here. So again, it just started to hit 80 here. We got a big green candle. That was followed by a smaller red candle. And again, that allowed the RSI to cool off a bit. But then price continued to move up again and shot through that 80 point again for a second time. And we had two more green candles. But then that was followed by a dip in price. And that actually formed a triangle before moving upwards. The next time we hit 80 was over here. And so that's just before this big crash that occurred in the 2008-2009 time. Let's have a closer look at that. So here is when it just hit 80, but you can see that price still moved up before it had a little bit of a break. And then it went for a second time to shoot through that 80 point over here. And again, you had a second move up before price cooled off a lot. So if you look at this, whenever the price hits 80 initially and then cools off and then blasts through that, that seems to cause a much bigger drop in the price after that bigger move compared to if it hits 80 and then you get more of a cooling off period. That gives it more room to move up later on. And then the next time it hit 80 was over here, which corresponds to this area here. And let's have a closer look. So here it just hit 80 here, and then you had and that was the green candle, and then you had a massive red candle after that. And that was that sideways move here that we got here. And after that, we haven't had any episodes of it getting to that level. except until now. So what we can say from this is that ideally we would want price to cool off a little bit to allow this RSI to cool down a bit. If this does shoot up further, which is entirely possible, then the RSI is going to go even further into this range. And what my feeling is that the higher this goes without cooling off, the greater the drop is going to be afterwards. So ideally we just want to have a smaller drops here, which is kind of slow and steady, and that will give us more room to push through that overhead resistance later on. But let's see what happens. Now, the other question is if we are to get more moves to push through that resistance, what is the catalyst going to be to propel it? My feeling is that we're going to need more talk of stimulus to push that through. And also, we're going to need a lot more retailers getting involved. Now, one of the things that people always talk about is, oh, well, that's a spot price. It doesn't relate to the physical price. But nobody's actually been able to give me kind of a way of actually showing a chart of that, and I still haven't come up with that. But this is the next best thing. I came across this website here, didthesystemcollapse.org, which shows the premium over spot for physical gold and silver. And they basically made these charts by getting the eBay lowest buy now price from dealers selling coins in quantities of more than 10. So for physical gold, this chart goes back to the 1st of April. And of course, the premiums were pretty high. They went up to 14% in April and May. And then we can see that they have cooled off substantially. And so now at the moment, they're around 6%. So to me, that says that that's not going to be enough to propel things going up to the 2000s. We would need to see, shortages of the physical to push that price up, I think, and the premiums up. With physical silver as well, we can see that the premiums are again cooling off. They got pretty high, almost as high as 60% there. And then they've cooled off. At the moment, they're about 30%. But that's still pretty high because normally the premiums are around that 10% kind of level. So demand does seem to be cooling off a little bit, but it's nowhere near back to normal at the moment. In terms of silver, now, when we looked back at gold, remember that we were pushing on towards breaking out towards all-time highs. With silver, it's a different story, and we've still got that overhead resistance level that we're still working at. So this is silver on the monthly scale in US dollars. And we've been moving up and down through this channel, which has been very, very frustrating for a lot of people. We had a spectacular recovery here, and now we're pushing on that overhead resistance here. Now, remember that silver does like to mess with you. It's not a clean, easy kind of vehicle to work with, I find. Although I've drawn this upper channel line, remember that's not going to be a hard and fast resistance line. Usually we're looking at resistance zones for these things. And if we look back here, $20, just above $20 seem to be some kind of resistance over here, here, and back here. So there's a few possibilities of what can happen here. But the thing to note is that once we get above this $19.50 to $20.50 zone, that kind of area here, there's a lot of thin air, and the next zone of resistance is actually not until we get to around the 27 to 28 zone here. So I think if price does burst through that, I think it's going to move up pretty quickly up to that 28 level. Now, it won't necessarily move up in a straight line. What will probably happen is, you can see a tiny bit of resistance here, is that it could move up, bounce down a little bit, and then go up to there. But of course, the big question is, do we think that it's time for silver to break out right now? The other possibility is that we could go down here, probably retest this support over here before making its move. And if we look at silver in US dollars on the daily scale, we can see a bit more closely where that overhead resistance is. We've been moving in this upward sloping channel, and it's been hugging the bottom of that channel, but it's still remained as good support. And so what we're watching for is these two areas here. So above, it's just above the $19 range. It's about probably 19.30. And below here, we're looking at around the 18.30 range. So if we do get a break below the channel, then I would expect support at around the 17 level now. And it may be that if that does break, as I said, we could move around here for a little while before making its next move up. I think this is probably going to, if it does drop down, it's going to be the last time. The next go that it has up here would probably be successful, but let's see. And looking at the GDX on the monthly scale, so in contrast to gold and silver, the GDX and the miners are somewhere in between here. So with the GDX, we've broken through this resistance level over here, but there is some overhead resistance over here, which is going to limit things. So for around just above 40 is where that resistance level lies. And so as with gold, silver and the miners, they're all hitting significant overhead resistance levels. Now, it doesn't mean to say they won't break, but they all seem to be moving kind of simultaneously. So I would expect them all to go in the same kind of direction here. The other thing to note is that we've got 4 pretty big green candles. So we've had an amazing run here. If we look back in the past, when we've had 4 candles in a row, so there's 4 over here, and that was just followed by a little pullback there. And then the only other kind of big run that we've seen is this one here, 1, 2, 3, 4, 5 candles, followed by a red candle. So, you know, a red candle may occur. I don't think it's going to be devastating. It's not as if I think price is unlikely to go down to these kinds of levels here. Possibly, if we drew a trend line here, ignoring this wick, then at the very most, we could go down to these levels. Remember that there were some gaps there that kind of felt a bit like unfinished business, but I don't know whether that's going to hold. The other possibility is that we just come and retest that before moving up. That's it from me. We're in some very interesting territory here where we've got some important resistance levels, and the big question is, what is it that's going to push gold, silver and the miners through those resistance levels? Are we going to get a pause before we go through there? That's all for this week. Hope you've all had a nice week. All the best and see you next week. Bye.